Right as the market's rolling over with the whole growth edifice collapsing under the weight of higher interest rates, we're about to get hit with the last thing we need. But we always seem to get at this juncture in a vicious decline. Let's call it a stock glut. I keep telling you that this period feels a lot like the inflation scare in late 2015 to early 2016, when the economy overheated, so tech got put through the meat grinder. And there's one more point of similarity. Back then, the high-flying cloud stocks got buried under a deluge of new IPOs of the same ilk. And you know what? We could see something very similar right now. Remember, as I always say, the stock market is above all a market, like any other bazaar of goods, meaning it's hostage to supply and demand. When you've got lots of new supply coming online at the same time, IPOs, follow-on offerings, lockup expirations, and the like, and not a lot of new money to stoke demand, it puts a ton of pressure on the averages. And that's exactly what's happening at the same time that yields are backing up, which would grind down stocks on their own. And look, right now, we've got lots of new supply coming online, lots of merchandise. It's not just the regular IPO market, which swung back into gear yesterday with a lackluster debut from this Oscar Health as a health insurance provider with a tech kicker. I mean, Oscar came public at 39, then opened down at 36 before finishing the session under 35. Then shed another 8% today. 6 months ago, Wall Street would have been salivating over the same deal, but there's no appetite for it anymore because money managers only have eyes for the reopening plays. They don't like growth. Well, this one should actually not have been brought. It kind of smacks of desperation. Next week, we've got some more big deals, like Coupang, the South Korean e-commerce giant. We got a pair of direct listings coming up, too, where the companies just list their stocks without necessarily creating any new shares. There's Roblox, the online gaming platform, which is another one that feels like it missed its moment. But there's also Coinbase, the digital cryptocurrency exchange that's more in tune with the current zeitgeist. Holy Toledo. I mean, it's just way too much supply. Now, you can expect more SPAC deals, too, with sexy startups effectively coming public by merging with special purpose acquisition vehicles. But lately, these SPAC deals have been getting a lot less love. Have you noticed? It's something I warned you about. No one wanted me. I saw it on Twitter. People got attacking me. Well, you know what? Stop attacking me and apologize. It's another sign of oversupply. Worst of all, though, we need to brace ourselves for the aftermath of last year's IPO boom. See, it's now been 6 months since the IPO business caught fire last September, and 6 months is when the lockup on insider selling typically expires. Yeah, put it all together, and the stock market is about to have a serious oversupply problem with no concomitant buybacks or dividends to fall back on this moment. Really, it's three overlapping problems. So why don't we do this? Why don't we take each one of them one by one, starting with new IPOs, because like at the top of the show, I want you to know all the reasons why we're getting pressured here. Including both SPAC fundraisers and traditional IPOs, as of last night, we've had an astounding 277 deals year to date that have raised $95 billion. Over the same period in 2020, we just had 40 deals, and it raised less than $14 billion. That's a lot of merchandise we got. Most of this year's IPOs have been SPAC deals, but it's a lot of money. Now, though, the IPO market is losing steam. There's usually a pause in the back half of February, but they opened the spigot for this Oscar Health, which came public with a thud. So now we've got the Coupang coming public next week. Number 2, by the way, on CNBC's Disruptor 50 list, the Amazon of South Korea. Except they also have DoorDash-style food delivery business. Coupang wants to raise $3.6 billion, putting it in the neighborhood of last year's largest IPOs. And at the high end of the proposed price range, this would be a $50 billion company. Long term, I think it is a good story. But short term, I mean, I just look at it as another e-commerce play, more merchandise hitting the stock market that we don't have a place to put. The Roblox direct listing is another one that I'd normally be thrilled about in a different environment. It's supposed to be hot, hot, hot. Not sure if this is the moment for an online gaming IPO, though, even if the company's very popular. Right now, we're talking about this stock glut. So what matters here is that Roblox just did a private fundraising round that valued the company at $29.5 billion, and they're about to directly list 70% of their shares in the New York Stock Exchange next Wednesday. That's a lot of stock. I think too much. After that, well, there's one that's kind of interesting, Coinbase, direct listing, coming later this month or maybe in April. Now, look, this could be a lot of excitement because it's about cryptocurrency, right? It's a cryptocurrency exchange. But again, let's talk supply. Coinbase shares have been bouncing between $200 and $373 in recent private market transactions. At the high end, that would give the company a $100 billion valuation. And it looks like the bulk of those shares will be available to trade immediately. Well, where are they going to put that stuff? And we don't know the exact proportions yet, but is there really an appetite for all that? Second problem, the SPAC attack. Yes, people won't stop throwing money at the SPACs. Last month alone, there were 101 of these IPOs where you basically hand management a pile of money that they can use to make acquisitions. On Tuesday and Wednesday this week alone, there were 17 SPAC offerings that raised $5 billion. Well, this is ridiculous. It is. Lots of professionals who should know better have started treating SPAC deals as a sure thing. Get a piece of the IPO, then make a fortune when your SPAC buys something and its stock spikes. But that playbook is not working that well now. It's incredible how fast this trade really did fall apart. So far this week, we've learned about 7 SPAC mergers. These stocks all start around $10. The best performer from this group is only at 11 and change. The worst 2 are now under $10. I thought that wasn't supposed to happen. Not long ago, these deals would have probably cost, 40, 50, maybe 80, 100% spikes. Now the closest you can get is Vector Acquisition, which spiked 36% Monday on the news it's buying a rocket company. But since then, it's given back most of these gains. The rocket companies, no thanks. Or look at today. We found out that Reinvent Technology Partners 5 is merging with Hippo. Oh, want some of that, right? An insurance startup. What happens if the stock plummets 6%? I mean, now, look, there was a time when you say Hippo, that sounds good. Now it's like, sounds silly. All this stuff sounds silly. What's changed? I think there are too many of these SPAC stocks and too many individual investors who've been burned by the ones that have started to implode. Like this Churchill Capital Fort, which ran up to $64 a couple weeks ago on rumors it would merge with Lucid Motor, an electric vehicle play, and then got pummeled when we saw the terms of the deal, plunging to as low as $24 today. People can only start taking, you can only take so many hits like this. I mean, that's big money to lose. Plus, this market has lost interest in the kind of exciting startups that SPACs typically merge with. How many charging station stocks do we really need? Third and final source of oversupply, lockup expiration Armageddon. In 2020, the IPO market raised $181 billion, and $100 billion of that was packed into the last 4 months of the year. Last September alone, there were 70 deals. Now, when a company goes public, there's usually some kind of lockup on insider selling, so the executives and early investors can't tank the stock right after the IPO. The terms of these lockups often vary, but generally they last about 6 months, meaning a lot of new IPOs are about to get hit with a tsunami of insider selling. Once the lockup expires, your stock, well, it can be toast. I mean, look, this Palantir's trying to hang in. Thank you to a particular fund that likes to buy it. It's big. But JFrog, Unity Software, I mean, that's just supply speaking. And we've got a bunch of big ones on the way. Snowflake, the huge data warehousing company, has been way down since its multi-stage lockup expiration got rolling, even as the company reported amazing numbers last night. Actually fared pretty well in this awful market. Tomorrow, we get the final lockup expiration. It'll nearly quadruple the size of the float. The company just reported that great quarter. Shareholders about to get swamped. Its market's unforgiving. I mean, maybe even it brings down a company that was able to go up $1.97 on a really hideous day. I'm also watching for GoodRx next week. Its float could increase tenfold. Corsair Gaming, one of our favorites, March 22nd, its float could triple. This, ladies and gentlemen, there's no room for this. Remember, these are just the beginning. There are more lockup expirations on the way, meaning more pressure for the stock market. I'm trying to get you to stop denying what's occurring. Again, we saw this in 2015, 2016, when we got hit with wave after wave of new stock from companies that had come public earlier in the year. Bottom line, the market is in rough shape, and it makes sense that it's in rough shape, and it won't get easier if we're trying to digest a massive oversupply of stock, given that there doesn't seem to be much new money coming in. Between the new IPOs, the SPACs, and the wave of lockup expirations, this could get even uglier than it is. It could get 2016 ugly, especially for the high-growth tech stocks that are already rolling over. Remember, we saw the market go down, many of these stocks, 30, 40%. The average stocks are down like 10% right now. Let's just hope the underwriters and even the companies themselves decide to pull their merchandise, realizing that this is a bad time to come public, and we need to stop the flood before it drowns us all. Much more Mad Money ahead, including my exclusive with FireEye Cybersecurity. It remains a major threat in the digital economy. I'm hacking into the latest in the space with the company's CEO. Then I'm breaking down a trend in this market that investors need to watch out for. So don't miss my take on the dangers of it. And all your calls, rapid fire, tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.